It's 11 a.m. here on the West Coast in sunny San Diego, and this is another edition as we kick off our new season of More Talk. We're going to be talking about the secondary conference review, and of course, it's me, Michael Zhao, on the East Coast at 11 a.m., and on the other coast,
It's 2 p.m. Eastern here in Boston, as well as in New York, where the secondary conference was this year, and the topic of our show today, for those who are passionate about the mortgage industry.
Yeah, we just had the Mortgage Bankers Association secondary conference, and it's always good as we're in conference season right now. Some of the questions that I seem to be having in the recesses of my brain really are at the conference. It's not the material that's being covered at the conference, and even though we're talking about capital markets and the secondary markets of how are interest rates being traded, what kind of new products are going to be introduced, all kinds of things that are, servicing, there's a separate servicing conference, but really what is going to be happening as far as product and pricing is going to be done as far as the mortgage industry is concerned. But my question to you, Michael, is while you were there, did you hear any tea that you are allowed to talk about with any of the birdies that you may have spoken to? Because as we go into conference season, really, it's not really the conference. It's all about these side meetings that we have on, everything that's going on behind the scenes, because we're going to hear about the things that are going to be happening in the news and the trade magazines, Housing Wire, and so on and so forth. But did you hear any good tea on maybe mergers and acquisitions, products that they wanted to talk about, but they didn't for any reason? It's just so super interesting for me to hear. We've had Mark Hansen on the phone on this show before talking about home equity as a potential product. I don't know if that was talked about as secondary, but I am curious to see, did you hear about anything that was new, making any new contacts, and what kind of environment was it at? Ralph had said that on his LinkedIn post that it wasn't really well attended. I was surprised for him to have posted that. And so let's go down the road real quick. So the first question I have for you, Michael, is was it well attended? And did you get the air that the in secondary and in capital markets that they were excited to be there, not just because they get to get out of the office, but in the prison of secondary and capital markets trading, but really were they there to get, product well attended, talking about hedging, talking about all kinds of things that were going on. What kind of environment did you experience while you were there?
Overall, I suppose it wasn't well attended if you were looking at it from the numbers standpoint, but it was well attended by the IMBs and the banks that are in the top 200 HMDA. The overall theme that I found was there are correspondents that want to get in or are in or are very interested in lending at today's rates, right? And it's finding, where do you get those loans from? So this one's less about buyer's agents and sales. This was about supply chain to me. And therefore it was, let's get down to business. Was it as yay, like let's go make, huge deals and change the world? No, I just felt like it was much more nuts and bolts. People were trying to find solutions for operational efficiencies. People were trying to find out what type of correspondence available. And I think, the market's really shrinking a little bit right now. And so I think that's more the feeling that Ralph might have said. I'll give you an example. Freedom threw an excellent party, second year in a row, not like their annual one, some famous band and huge, but very intimate. They there's a lot of events on Monday night, a lot of them. The trading platforms, the PPE firms, the MI companies, ICE had one down at Wall Street, and Freedom's goes the latest. So there's a lot of dinners happening, right? And so everybody, when you look at it, a lot of them end at 9 and that one ends later. So it's just easy to end up there. So it was very well attended. And they are closing a lot of correspondent business, Mike, and they're outbidding everybody. So you have a lot of other correspondents saying, we want business. I believe it's that race that we've heard about to $1 trillion. So you already have Mr. Cooper there, and Stan wants to get there. And I would say birdies would say they are somewhere at now maybe 10 billion a month they are buying, and they're outbidding everybody. So when you go to bid, they're there. If you want to sell it to them, they'll take it. And so I think that is similar to what maybe is happening on the broker side with UWM. You have these dominant places that all the loans are going, and these people think they can recapture better off of their servicing portfolios. So it's a sign of the times. You're going to sell your loans, and they are bidding in one of the most recent bids. I think I said on the show, a birdie told me 6.5 times, so like 6.5 years to break even on it. Highest purchase since 1994. They're giving a good offer for this MSR, this correspondent, if you don't mind them servicing it and possibly selling to them in the future, right?
Mm-hmm.
And that would set up the futuristic talk that we talk about. But I didn't get the futuristic vibes. I don't have those giddy feelings coming out of here. But I would say that I believe in mobile apps. I think the industry has a huge deficiency in them. I even feel more coming out of this conference. But they're able to get all these servicers servicing clients on these apps. 5 years from now, it's going to be even harder to close a loan because I think the market's going to be even smaller because these servicers are going to be able to recapture people a little bit better. Or there might be AI to just re-up it without it feeling like a mortgage, right? So you heard it here in more talk in between seasons 2 and 3. So when we're on season 25, we can come back here and say, I kind of warned everybody of that part.
That's interesting because, we just had CMG on a few weeks ago, and where we had servicing and sales together, and for them to talk about how they are utilizing it for their database so that they can retain a lot of that business. And I'm surprised to hear at secondary there wasn't a lot of other ancillary services looking to capital markets to see how they can work together, especially after we just had our show, Mike. I mean, we just had a show combining secondary and sales together, and it would have been a good running start for them to figure out how can they put the two together to back solicit those servicing clients, right? It's not just about the servicing and the fees and this, that, and the other. It's also about client retention, and I think that's going to be the key component, especially as you talk about the applications that's going on. And so if they want to retain that the present business for their future business, I agree with you. The mobile app is something that is underutilized, under talked about, and it's got a hockey stick type of growth potential when it comes to servicing. So I'm very surprised to hear that from you. Did you hear very much from Owen Lee and the Mortgage Action Alliance? Was there very much talk about that?
Yeah, I mean, there was talk about obviously a battle ahead. Chopra was there and he presented, and so he had the laugh out loud funny moment of the conference, was what I heard. So he came in, and one of these birdies told me he had called the MBA about 2 weeks ago, not him personally, someone
On his team.
Mm-hmm. Not saying he was going to use it for this speech, but he came out and completely went after the price of a credit report increasing the way it did. It is a junk fee, and how something will be done, needs to be done. And then the laugh out loud moment, and this was packed with all owners of, the players of MorePack, if you will.
Sure.
And what they wanted to hear, right? Taylor Stork's been saying this, Community Lenders of America. I mean, if they actually peel it back, they'll find out there was, I don't want to say the wrong alleged word, but if Community Lenders of America didn't come and make it fair for everybody, when they first piloted this, the top 25 to 50 lenders were paying traditional prices while everybody was paying these new prices, which someone was telling me equates to almost like $360 a credit report fee per loan now. Because if you assume you need to pull 4 to close 1 these days between pre-approvals and qualifying, and the price, I think of these, if you look back at maybe our episode 1 of the last season, I think Sue was starting to talk about it, but I
think it was episode 2, by the way.
Episode 2.
Mm-hmm.
But the price went from, say, I believe it was like $36 a tri-merge,
right,
to $75, right?
Right. Which
I
is
mean,
crazy.
crazy. I think that was like a soft pull, and a hard pull is like 150, right? Or a
Yes.
soft pull went from like 16 to 75, and the other went from like 30 to 150 5 times. And then the credit bureaus blamed FICO and FICO blamed needing to update their algorithm. And so after Chopra saying all of this, Mark Jones, president of the NBA, has to pull out this piece of paper after 25 minutes of Chopra going off on this and digging in. He has to say something along the lines of, and today's, guest and presentation is brought to you by FICO, the world leader credit. Yeah, there were people on the ground laughing, I heard. It was very awkward, very funny awkward. A lot of laughs there. And that was kind of the buzz that definitely jumped into that junk fee blog. And now here it comes. Credit, reporting, junk fee, title. A lot of people were talking about title because you saw that in the news, right, with Ishbia. And, another birdie says could be appraisals too. And where this junk fee, their solution, which I heard the lenders are up, this is where they want this more pack money going to, is they know they're going to have to pay for it in the BIPs, right?
Right.
So if lenders have to pay the title, and maybe Bertie told me, what if lenders have to pay for the appraisal? But the other argument to that is that they can negotiate better, right? They can negotiate the upfront price versus what they're rolling in. And the problem is the margin isn't always there. Like it isn't until recently so it's going to come out of points and pockets.
In relative terms, I mean, I'm just thinking out loud for a second here, Mike. But the way I see it is like, for example, title insurance protecting title, credit report protecting the credibility of the borrower. When Chopra was talking about that, did he also include, for example, verification of deposit, verification of employment? I mean, does that include as part of, did he define that further, or was it only credit report?
He said it was CRA fees. So credit reporting, maybe rescoring, right? Just any fees around and he went after the work number a little bit. So the work number.
Speaking of verification of employment, right?
Yeah. He wasn't happy with that. Nobody's happy with that, right?
They're the only game. It's like, we need to verify employment. It's like the work number. It's like you talk to every processor on a nationwide basis. They're like, yeah, we use the work number. Is there anything else? Maybe.
Yeah, the other one that's popular is Truve, right? But
yes,
what I've heard is outside of hit rates and whatnot, it's has the same problems you might run into with people anytime they have to opt in and do things. With the work number, you're really putting in your number, and if Equifax works with them from an HR standpoint, you're good. If they're on ADP, you're good, right? With this, you got to go through a series of logging in really to your payroll providers, and some of these load screens take very little time in the old world, like 20, 30 seconds. But in the new world, when you're on your phone and you're doing whatever, a million things at once, right?
Mm-hmm.
20 seconds causes abandonment. And then they end up back at the work number. So
yes,
it's on the radar of Chopra. That is, anytime the consumer's paying more in this area, they're considering same way they went after credit, where they're going after overdrafts, right? They want to bring that from $37 down to $8.
Mm-hmm.
I'm sure there's a lot of collateral damage there, but it's not just, they went after it in Ticketmaster. It's not just mortgage, but once they find something, I feel like they are extra good at finding people in the mortgage industry versus these others. Come in with their teeth.
And for our listeners that are out there listening on Spotify and our regular consumers, can you just say who Mr. Chopra is, who he belongs with?
So he is in charge of the CFPB, and after a
Consumer Finance Protection Bureau.
Consumer Finance, yeah. Acronym alert. And he also were deemed unconstitutional in a southern district court, right? Like Alabama or Arkansas. And that was just overturned by the Supreme Court last week. So they do have the ability to stretch their budget, and they technically don't have much oversight. And why we, if you listen to our episodes, when we go to DC, we're not against CFPB as an organization, as a trade. It's that they enforce through announcements and through enforcement, or they tell us their rules through announcements and enforcement. So they don't actually have FAQs. And so the way you find out is you get hit with millions of dollars of fines, or a peer does. And so it just causes a lot of conservative actions that end up costing the consumer money. That's the big knock on it.
Right. And they are an enforcement bureau, not unlike the Federal Bureau of Investigations, but they are just another governmental bureau to enforce consumer finance protection, not just for mortgages, but for credit cards and banking alike, and lending as well. So it's important for our consumers who are listening to know who the CFPB is and why is it important that they speak to the Mortgage Bankers Association.
Yes. And so that was the big hit. That and Michael Frantoni.
Frantantoni, yep.
Frantantoni did announce the latest findings that the average retail mortgage lender lost $645 per loan, which is down.
Wait, 600 or 6,000?
$659.
But that's good news.
Yeah, that's down from $2,400 in the previous quarter. And then when you add Freddie Mac's findings on top of it, it is really the top 25% are profitable, close to profitable. It's that bottom 25% that is supposedly losing, or it's costing them like $20,000 a loan. It's costing like $6,900 a loan for the top 25%,
right?
$24,000 for the lower. I heard an average IMB or mid to smaller, they're looking at right now about, I think it was $10,500 a closed loan, or $11,500. The problem's been the yield, in there to use yield to pay for it versus charging your consumers points.
Right.
And it sounds like it might be coming back a little bit in the products because of the consistency of the rates and the belief maybe that they won't go down as fast. So no one wants to get stuck with it.
So also
liquidity in that second loan space too was talked about there.
So for our listeners on Spotify who don't necessarily understand what that means, it's a lot of listeners seem to understand that the interest income that lenders are generating is the sole source of how income is generated, along with all those junk fees and so on and so forth. But there's an entire market out there where mortgage loans are bought and sold. And over the course of the last year, as interest rates began to go up, the prices actually of mortgages were beginning to go down. So they would actually be sold at losses, and which doesn't make a lot of sense, except if your sole business is to generate mortgages, and if you're loaning at 6 or 7 but borrowing at 10, you got to get that paper off of your line of credit. And so that's where some of the losses are coming from, because some of the independent mortgage bankers may be borrowing at 8, 9, or 10%, but funding at 6 or 7 if they because that's the way that it's kind of being done at the moment. And so that's where some of these losses are also being come from. It's not just the income being generated from the mortgage payments, but more independent mortgage bankers also have to pay interest income to another lender, because they are borrowing off of what they call a warehouse line. And so if they borrow money off of their line of credit, also known as the warehouse line, then they're paying that extra interest. So that's where also some of the losses come from. So some of our listeners that are consumers out there may be going, oh, I didn't know that. So that's why certain mortgage companies are actually losing money, even though they are funding a mortgage loan and supposedly charging me all these extra fees and extra points. They're not doing that just for the sake of charging fees and points. They're doing that so they can actually be a profitable company or losing less money. And I think it's important to know that as interest rates begin to come down, get some of that money back.
Very well said. And then a lot of it comes from after the loan closes, they have to decide if they want to keep it or work with these correspondent lenders that we mentioned earlier, right? Do you want to talk about maybe a correspondent lender, Mike, and why a consumer may never know about them, but if you're interested in mortgage, why it's a secret part of liquidity and how the world goes around?
Right. So if you're independent, so if there are what they call mortgage brokers, and then there's also, and we've talked about it on our show, the IMB, the independent mortgage banker, and they may have what's called a correspondent line with another bank. For example, let's say XYZ Bank, XYZ IMB, so we'll just call them IMB for short, has a line of credit with XYZ Bank and or XYZ other mortgage bank, I should say, and that will be a correspondent line. And that correspondent line says that they're going to buy that mortgage loan, and they have to get the right pricing so they can either get the right price so that they can buy immediately, or B, if they have other what they call pre or post funding conditions that they haven't satisfied, they have to pay the extra interest on that line. And it may be to their favor and it may be to their loss. And so depending upon how, if you're being stipulated, I want this extra document, this extra letter of explanation, I need this extra pay stub, I need this whatever issue from title, from escrow, from the buyer, the seller, whatever it is, that situation. If you're missing documentation and it doesn't conform to the guidelines of that correspondent lender, in every correspondent relationship is going to be different. So, for example, there's a bank out there that they may want 36 months of reserves, whereas another correspondent lender may only want 6 months of reserves, of savings reserves from the borrower. And so every correspondent relationship is not only going to have different types of pricing, but also they're going to have different types of stipulated conditions that they're looking for when buying or taking off the line for the independent mortgage bank.
They were a big part of the conference, obviously. Deep Haven, Village Capital does government. FHA met with them, no overlays. And
can you explain what an overlay is real quick? I know what it is, but for our listeners,
it could be any rule specific to the correspondent that allows them to say they do not want the loan. And typically it'll be a one-off that Village is trying to say they don't have no overlays. They're trying to say, other correspondents will say they don't have any overlays, but you might get a deal and say, well, this, if it's a condo in a high rise, we require that the condo association at least has enough money to cover a new roof. They're usually a little bit more matrixy than that, but that would be where they go, so we're not going to buy this one. And then you say, I thought, XYZ. That would be an overlay. Sorry, we have an overlay on condos.
Yeah, I always consider overlays like aftermarket parts on vehicles. You got to pay extra for that. Well, what if I don't want it? Well, if you want to sell the vehicle to this type of buyer, then you need to have that overlay or that aftermarket, whatever, the extra spoiler or the radio system or the alarm system or something like that, right? Something to make sure that the buyer on the other end is going to be happier.
That was it sounds like a lot of these correspondents are pulling back a little bit on some overlays to try and win business. But again, that was the theme that I saw there, is the correspondents are willing to be agile. And maybe it was just the ones I sat with, but they'll work with a credit union. They'll do Dell, non-Dell. They will use third-party software out of an LOS. And can they get, there's only so many people there, was the point I think people were trying to make by a low turnout. There's only so many that are doing mortgages differently, and otherwise it's the same names, and they were there and they were strong and they're all the top lenders, and they probably have the same bidding software, which sponsored, the events. The first night, MCT had an incredible event. It was a full house, absolute full house. They had the only event on Sunday, 3 floors, and everybody was there on both sides. I met a couple people from Mr. Cooper, Chief Operating Officer of NFM Lending. Greg Schur was there. He's really become quite the face of the industry, and his personality is so, he had his All of Us shirt, but it's just so magnetic. People come over and want to talk to him. But the night before, I got to meet one of the partners in the company, operations. He was at MCT, so both sides. Planet Home Lending is doing a lot of correspondent business. They had a large event to thank their investors and people working with them. ICE was, they actually a little
ICE. The reps from ICE were at the MCT party.
I don't know if they were. I was going to say ICE had an event where you could walk on the floor of the stock exchange.
Wow.
Problem was, and this was a thing I heard earlier in the conference, a rumor that for the first time in 30 years, the secondary they're thinking of moving away from that Marriott marquee. But I think by the final day, they did re-up for next year. They wanted to say, if we're not going to be on Wall Street, which I don't think there's enough hotel to handle it,
Right.
but that's why I didn't go to ICE. One of the reasons is Wall Street is about a 38-minute cab ride from Marriott Marquis. I heard that on Sunday there was a parade. People who had like $99 Uber rides from their Wall Street meeting back to the Times Square. So they're saying if we're not actually on Wall Street, why not start moving it around? A lot of these lenders are meeting with hedge funds and large money institutions there. So I still think they find a way to meet them, and then it's a trickle-down effect. So I think it's serving its purpose. I think people meet halfway or find their way up there. I'd be very interested to hear why you'd want to start moving that around. Though it is expensive. Everything's expensive, right? So the people renting the events, I guess you could argue the hotels are all very expensive there. But yeah, a lot of talk about liquidity for second mortgages, HELOCs, HEI. There are
Yes.
now, and I was talking with some companies, and happy to share with you offline, Mike, but there's hedge funds now and credit unions aligning with technology companies to deliver better second mortgage programs. And, Figure is a big one. They are on one side, they have the blockchain, right, with Mike Carney and that thing going for them. On the other side, I think they've brought more liquidity even this past 2 weeks. I think they did another securitization. So, but I also here's the problem. Somebody I heard, another birdie, said they sent them like 750 deals potential, right? And I think they closed like 10% of them, so like 75. So loan officers are so rusty at second mortgages. They've never really even been able to correspond to them. They've all been brokered. It's going to be that trust factor of loan officers not really well versed on how to deal with setting somebody up 90% of the time to be rejected, right? That's a Mike Kelleher takeaway. That wasn't like the theme, but that's kind of the two and two I put together. And the opportunity cost of not showing your consumer that that's available because you're afraid of rejection is like anti-sales, right? So there's just going to be some good programs available. It's how to loan officers tell their go-to consumers and understand that it's better longer term. Because I keep saying the Tapper thing, I think applies to everything. If you go to a restaurant once, there's like 32% chance you'll be somewhat of a go multiple times that year, regular. And then it jumps up to like 38% the second time. But you go the third time, it's 72%. I think it's like the same thing in anything. So, I want to say like second mortgages count. And if you think you're going to do 3 deals over the next 4 years on first mortgages with your clients, it's going to be tough sledding. But if the second mortgages count and you can get to 3, what a flip that is, from 30 to 70% chance you become their go-to person. They tell other people and they really just naturally go to you. So seconds count in my mind. And I'm speaking and probably going to be hired to distribute one program that's a HELOC or closed-end second. A lot of these are like closed-end seconds or they're going to follow the Figure model where if they're a HELOC, no prepayment penalty, you have to take the draw. And I guess technically you could put it back in 60 days. Remember that? Wasn't that a thing too back in the day?
Yeah.
That's definitely a thing with Figure. Like that's part of the sales kind of. I don't know if you say it or don't say it, but that sort of seems like you're selling the HELOC, but they have to take out, I think, 75% in the beginning, and then they can put it back pretty soon after.
That's kind of like what they do in the car industry with you got to take out the whole loan, but if you want to pay cash, you got to wait for like 2 weeks or something like that. I'm hearing in the family market and the private money space that they're trying to figure out how to give IMBs more avenues to buy short-term paper, and they're trying to figure out what is the differential amount of monies that's available to provide to the independent mortgage banker for HELOCs, and then also for short-term paper less than 12 months. So how does the IMB actually sell at a profit this short-term paper for fix and flips. And I think that because that's becoming, and Mike, I sent you the text message earlier this week of housing permits, housing starts, as in, to each geographical MSA across the nation. And so they're looking at those housing starts in comparison to the jobs number and figuring out what are the marketplaces that they have a willingness to do this short-term type of financing. And IMBs can get involved and say, hey, you know what? Because the way I see it is if it's really 6 to 12 month paper, you could be making as an IMB anywhere between 5 to 8 points per million after everything is said and done. And that's gross. That's before paying out commissions and support staff and so on and so forth. But if you're going to have a line of credit and you're still going to make a 2 to 4% spread on the interest on top of that, there's an opportunity not only on the home equity line of credit side, but also on this fix and flip side on short term. So you have one aspect of the home equity line of credit or the home equity share, which is some long-term paper, and then some short-term opportunities as well. And so I know that we got asked to have a few meetings actually at the secondary. I wasn't able to go, but as we have a few more family office and private credit conferences coming up in the summertime, one in Chicago, one in Monterey Bay for us, we're going to be looking at. I had a private conversation with BlackRock. They're looking at like a small investment of about $250 million into that space. And so it's pretty exciting to see that there's more money that is going to be entering into the space. And I'm excited to see what kind of new products they're going to be putting out there.
Yeah, I mean, I was able to sit down with you with a couple good IMB owners that are doing it that you wouldn't even know. And their ability to leverage today's software, right? They do it inside Encompass. They're servicing it on another software they have. They have marketing sheets that apply to residential they can bring over. Mm-hmm. They have the data in their LOS, and they just came up with a program and really built it a lot on trust, I think, right? And so they know their areas, they know the appraisers, and yeah, it was interesting watching them speak with you and then your background in underwriting and being able to evaluate rollover, short-term interest. And I think if you combined a couple conversations with you, plus the tech they have, plus the avenues of these providers willing to really clear off their risk pretty quickly so they can go out and re-originate and charge points and at their high rates, their points, and all of their customers are extremely happy because it's better than some of that prop tech marketing out there, right? That these people end up with, which are these loans that maybe don't fund or they're just as high.
And for consumers that are listening out there that may not understand what we're talking about, the interest rates for those are typically between 11 to 14%, and the average FICO score is going to be somewhere about 720 to 760. And if you're an average consumer that doesn't own any investment properties, or you just don't understand why would someone who has maybe a 6 or 7 figure bank account, why would you go and borrow money at such a high interest rate? They're utilizing, number one, the shortage of inventory that's available in the single family market right now, and buying the houses that people just don't want to live in because of condition, and they're basically fixing and flipping. It's stuff that used to be when people would watch late night infomercials. It's stuff that is still made. And I think that because there are people with good FICO scores, high reserves, high credit scores that are borrowing at these rates, willing to pay the fees, knowing they're going to be a profit, it's a win-win across the board if it's underwritten correctly. And I think that's super exciting that it can be profitable for mortgage companies, profitable for the investors, and good because it's introducing better product to the end consumer, which is typically the first-time buyer. So it's a great market, and I hope that we can get to dive into this in the future a little bit more on another episode, Mike.
I think that would definitely attract a lot of listeners. People are always looking to find out what they don't have access to that others do, right? And you can drive around and see opportunity. There's a lot of great contractors out there that are not rusty. They've been doing a lot of work. People have had flush money. They were stuck inside for COVID. They did extensions, right? Maybe business is slowing down a little bit, but they're at their peak they're well staffed. They've been hammering and finished carpentry, and they're not rusty. They know what they're doing, and maybe they have opportunity. So a reason to tune into our show.
That's
We
right.
did say we'd ended a little bit early, but we're still like on pace not to.
I know.
Trying to think if there was anything else to get across from the conference for you. Oh, I'm going to be working like a trader now, Michael.
What do you mean?
Well, I don't know if I can officially say how it's going to work, but I work right now with Aster Key, which is a company that's a mobile app, but you can also have it as a lender that has the ability for people to apply without really saying who they are a lot further down the process. And because it's a mobile app, I'm so bullish on mobile.
Sure.
And I think the industry's so far behind on it, and they should be taking any way they can get involved. If they're not going to market it themselves, start buying leads from these companies. These are not lending tree, though they feel like it.
Mm-hmm.
But they're the real future that you don't understand how to, say, market it directly to get a funnel coming in for your loan officers. You can go here and stay at it. So Aster Key's one of the few that stands out to me. And the other one who's a good friend of mine and friend of the show and just a friend of just always going in the industry, is Brent over at Form Free, which created an account check. But now he has the new Form Free, which is a way for consumers to build their medallions and really share their financial information and own their own financial information and have something on the ledger that says it's them. And then the lenders can buy these medallions, vetted lenders that Brent knows, right? Or I know. And so Brent has a lot of medallions now, a lot of consumers that want a mortgage, but they really come from, more of these come from areas that would be CRA eligible or come from areas that are underserved. And that's purposeful by the way that Brent has been marketing it, but it is an app that it starts on. I know the people he's working with are backed by Shark Tank and know how to funnel. And so if you're a marketing company or you're a mortgage company, you don't have that marketing in-house, you could buy medallions and really hedge yourself from being so out of touch with your digital marketing, customer acquisition strategy. You could start buying medallions. So I said, maybe I'll wake up every morning with the tear sheet and call them until I'm out of medallions for the lenders that are willing to talk to me. So we're in talks to complete that, where I'll get them in the morning and I'll push them. But they are getting more medallions by the day, and they're getting more relationships coming where it'll be inside of well-known places that consumers are on their phone, and while they search for real estate, and there'll be a medallion button in it. So they're going to have more and more medallions. And that was my other takeaway. There's like those type of products that are coming to the market. Lenders need to get with that, because the stuff that kind of got you here till now will not sustain in this new world where, especially now that AI happens, where there's just too much automated marketing and keeping up with it. And if you don't have an influencer division like NFM, you're going to have to piggyback something, and you're going to have to know the bips in your mind that they quote cost after conversion. Get it below that bip number. This is not the medallion side. This is just bikes from what I've heard from these other big companies do it. If you can get that number down to where it makes sense, let's say 70 to 90 bips, like that's where you need to go. Then you can buy as many. You should be buying as many as you can, whether it's a medallion, an Aster Key, or whatever's next. But that's where, I have all these clients on operational efficiency. I'm working with you to try and help people understand that the new money correspondent hedge fund, like those type of, you got to be aware and have stuff that's unique. This is the third leg of the stool. You need a true either customer acquisition company, or you need to start buying tangible sources like an Aster Key, a medallion, or who knows what's next.
Do you think that's going to be different from a consumer direct division for the servicing portion for an independent mortgage banker, or is that going to be like kind of like an offshoot? Like, Greg really kind of has it. He's on the cutting edge as far as having their own social media division of origination, right? With what's her name, Rachel McNutt or something like that, and the team that's working with them on that. But to have like online leads that are pushed as a result of AI and as a result of just of servicing and all these things that are coming together. That's super interesting to me that there isn't more applications that you could have push. It goes from internet or consumer to internet into the application, and then it's pushed over to the IMB. And I think that it's still underserved. So I'm interested to learn more about that so that we can figure out how to educate more of our listeners that are out there for this that are IMBs.
In the Aster Key and the Medallion from Form Free, like those are consumer direct plays, and you'd want your consumer direct, not division, but you'd want your best loan officers that match what they're doing selling those. So Aster Key is made for people that delete the apps right after they download them. Put that put that thing over their computer so no one's looking at them. Like our computer science majors, your introvert, nephew at the right, who never brings his laptop outside of his house and always talks.
You know what, Mike? The 40 to 50-year-old loan officer would not qualify for that type of lead because they wouldn't. I mean, they would know how to convert if they were able to talk to them. It's like, but like the 50-year-old loan officer, they're just like, I never have to talk to the consumer, and I'm shopping price, but still providing value. It doesn't make sense to that loan officer. And it may never make sense, and it's not supposed to make sense, actually, in my opinion. So, and I understand because I am that person. So, there's a new type of originator that's coming about as you talk about that on how to communicate because they're communicating much differently now than they used to. Not so tonality or emotional based, but more factual based, and then putting it all together. So, very interested to know more about this and how it's going to affect the future of originations for sure.
Yeah, and like the NFM, which is a lending company for the listeners out there, that actually has loan officers go on TikTok and social media that have millions of followers, or when they have views, they have been able to get over 100,000 views, which if you're listening here, give us a subscribe and a like, but you'll see from our views, that's not a small feat for the topic of mortgage.
Right.
I know some of these companies, and it's not even NFM, but it's like the only other one that has this much following. When they have something tangible, on Pro app, like the FinLocker app that they're able to white label. That's the difference. I'm a big white label fan. I think FinLocker, easy mortgage apps, get yourself a white label app. Aster Key, Medallions, those are not white label. They're going to go get the consumers to download if you're not good at it, which is almost everybody. But these two companies are really good at getting people to follow them. And so this one person that has 1 million followers, Brian was telling me, those companies can get, if they just talk about the FinLocker app, like 7,500 downloads over the course of a year because they're turning the eyeballs into something actionable, keeping track of your finances, right?
Yeah.
If you don't have a loan officer with 1 million followers, or you are afraid to help that loan officer get 1 million followers because you think they're going to go to another company, that's where I'm saying the Medallion, the Aster Key, like I can give you advice, but I think that's your other option. But if you're doing neither option, you are dealing a lot with what Michael just said, which is 50-year-old loan officer, right? Giving you advice on how it should be, which will work for a little while longer, but keep following along here. I talked about earlier in the show, you're going to be against mobile apps that are servicing apps, right?
Yep.
All they have to do is put something in there that is cooler.
Hey, I was just looking at the clock. We intended on cutting the cord about 20 minutes ago, but we actually had a lot to download from the conference and to talk about this. So I'm grateful again for another week to be able to talk to you, talk about what's going on, and talk about some of our colleagues of how they are changing the course of lending.
Yeah, great show. Looking forward to catching up with you offline, and looking forward to really ramping up season 3 very shortly. Stay tuned. Give us a like and a follow because season 3 is coming very soon.